One of the most popular questions we get at freeandclear.com is what mortgage program is right for me. We're going to review the three most common mortgage programs, fixed rate mortgage, adjustable rate mortgage, and interest-only mortgage, and discuss the positives and negatives of each type to help you select the program that best meets your financial goals. First, I'm going to summarize each type of mortgage program. A fixed-rate mortgage is the most common type of mortgage, and it is also the simplest to explain. With a fixed-rate mortgage, your interest rate and monthly mortgage payment do not change over the life of the mortgage. So if you get a 30-year mortgage, your first mortgage payment will be the same as your last payment at the end of year 30. The next type of program is an adjustable rate mortgage, also known as an ARM. The initial interest rate and monthly mortgage payment for an ARM are fixed for a set period of time, called the fixed rate period, which is usually the first 3, 5, 7, or 10 years of the mortgage. After the fixed rate period, the interest rate and monthly mortgage payment can change on a predetermined basis, which is typically every year, for the remainder of the term of the mortgage. This is known as the adjustable rate period. The most important thing to understand about an ARM is that the interest rate and monthly mortgage payment can change and potentially increase over the life of the mortgage. The third type of mortgage program is an interest-only mortgage. The most important thing to understand about an interest-only mortgage is that you pay only interest and no principal during the initial interest-only period of the loan, which is usually the first 3, 5, 7, or 10 years of the mortgage. This means that you do not pay down your mortgage balance during the interest-only period. Following the interest-only period, the interest rate and monthly mortgage payment can change on a predetermined basis, which is typically every year, plus the borrower is also required to pay both interest and principal for the remainder of the mortgage term. This is also known as the adjustable rate period, and this is why interest-only mortgages are also called interest-only adjustable rate mortgages or interest-only ARMs. And because the borrower has to pay both interest and principal, and the interest rate may increase, the borrower usually has to pay a higher monthly mortgage payment after the interest-only period for the remainder of the mortgage. I'm now going to draw a graph that compares these three mortgages to give you a sense of how they work. Let's say all three mortgages have 30-year terms, and the line I'm going to draw represents the monthly mortgage payment for each. The fixed-rate mortgage is pretty simple. Because the monthly mortgage payment for a fixed-rate mortgage does not change over the life of the loan, I'm going to draw a straight line from year 1 through year 30. The next line I'm going to draw, our red line, is the line for our adjustable rate mortgage, which is a little more complicated. Let's say we're drawing a 7-1 ARM, so our interest rate is fixed for the first 7 years of the mortgage and then is subject to change on an annual basis for the remaining 23 years of the mortgage. So I'm going to draw a straight line for the first 7 years of our ARM, which represents the fixed rate period. And as you can see, the line for our ARM monthly payment is less than the line for our fixed rate mortgage. This is because the interest rate for the fixed rate period of an ARM is typically less than the interest rate for a comparable fixed rate mortgage. So our mortgage payment is less. After the fixed rate period, we have the adjustable rate period during which the interest rate and monthly payment for our ARM can change. It is impossible to predict exactly what interest rates will be in the future, so our ARM line could really go anywhere at this point. But for this example, let's say that interest rates increase over time, so our monthly payment line increases in year 8, the first year of the adjustable rate period, and then kind of goes up and down for the remainder of the mortgage, but our payment for the last 23 years is always higher than our fixed rate mortgage payment. Again, this is just an example, but it shows you how an ARM works. Next, I'm going to draw our blue line for our interest-only mortgage. Let's say we're drawing a 7-1 interest-only ARM. So we pay only interest at a fixed interest rate and no principal for the first 7 years of the mortgage, and then we pay both principal and interest, and our interest rate and mortgage payment is subject to change on an annual basis for the remaining 23 years of the mortgage. So I'm going to draw a straight line for the first 7 years of our interest-only mortgage, which represents the interest-only period, and as you can see, the line for our interest-only mortgage payment is less than the line for both our ARM and our fixed rate mortgage. This is because we're paying only interest and no principal, plus the interest rate for the interest only period is typically less than the interest rate for a comparable fixed rate or adjustable rate mortgage. After the interest only period, we have the adjustable rate period. So just like with our ARM, it is impossible to predict what interest rates will be in the future, but because we start paying both interest and principal, our mortgage payment will increase during the adjustable rate period and could very likely be higher than the payment for both the fixed rate mortgage and ARM for the remaining 23 years of the mortgage. And that's what we show here. Although this chart only represents an example of one potential outcome of the three types of mortgages, it does a good job of framing the positives and negatives of these programs. Our fixed rate mortgage represents the lowest risk option because our interest rate and mortgage payment never change. So the biggest pro of a fixed rate mortgage is certainty. The con of a fixed rate mortgage is that our mortgage payment may be higher than an ARM or interest-only mortgage for certain periods of time. Additionally, if interest rates decrease and we cannot refinance our mortgage, we may be locked into paying a higher interest rate. For our adjustable rate mortgage, the big pro is that we potentially have a lower interest rate and monthly mortgage payment during the initial fixed rate period as compared to our fixed rate mortgage. Plus, an ARM also offers the potential benefit of a lower monthly payment if interest rates go down during the adjustable rate period. The big negative of an ARM is uncertainty. It's really hard to predict what interest rates will be throughout the adjustable rate period, and your mortgage payment could increase significantly. For our interest-only mortgage, the big pro is that we have a lower monthly payment during the interest-only period as compared to a fixed-rate mortgage or an ARM. This lower monthly payment typically allows you to qualify for a larger mortgage, which is another benefit. Like an ARM, the biggest negative of an interest-only mortgage is the uncertainty. Not only could interest rates increase during the adjustable rate period, but you could also start paying both interest and principal, so it can have a double effect and your mortgage payment could increase significantly. This is why the interest-only mortgage is the highest risk option. So what program is right for you? It all depends on your risk profile and financial goals. If you're looking for certainty, then a fixed-rate mortgage probably works best. If you have a higher tolerance for risk and are looking for a lower monthly payment or larger mortgage amount, then an adjustable rate mortgage or interest-only mortgage may be right for you. One point to highlight is that if you know you're going to sell your home before the end of the initial fixed rate period for an ARM or an interest-only mortgage, they could be the right program for you. That way you benefit from the lower monthly mortgage payment during the initial period of the mortgage, but you are not exposed to a potential increase in interest rates and mortgage payment during the adjustable rate period. This approach is not without risk either, as there is no guarantee that you can sell your property for more than you paid for it. So selecting a mortgage really comes down to choosing a program that best meets your financial objectives. Now that you have a better understanding of how each type of mortgage works and the pros and cons for each, you can select the one that is right for you. We encourage you to review RelatorFreeClear.com videos such as our overviews of fixed rate, adjustable rate, and interest-only mortgages, in addition to our detailed discussion of these mortgages and mortgage program comparison in the mortgage program section on FreeAndClear.com. Thank you for reviewing What Mortgage Program is Right for Me with FreeAndClear.com. FreeAndClear.com.